Hey there, everyone. Dave Keller with Market Misbehavior. I'm the founder and chief strategist at Sierra Alpha Research, and I'm so thankful you're joining me here on my weekly show on StockCharts TV. It's a pleasure to bring different charts and ideas and themes and hopefully thought-provoking content to you every week. And I appreciate so much you checking out the video. We're going to talk today about key levels to watch for each of the Magnificent Seven and friends, and I will, I've sort of developed a growing list of mega cap growth stocks. So it's not just the original Mag 7. I think I'm up to about 9 names now in this list, but these are key names I think that are so pivotal to watch. And why are they important? Obviously, dominated returns in 2024. I mean, 2024 was the year of the Mag 7, and certainly at points in that year, it certainly felt as if the Magnificent Seven stocks on their own were single-handedly driving the market higher. All of that changed so far here in early days of 2025 as we get toward the end of the first quarter. Magnificent Seven stocks have been underperforming most other things, to be honest with you. Underperforming value, underperforming bonds, underperforming hard assets, underperforming cryptocurrencies. That might not actually be true, but I might have made that last one up. but underperforming quite a few things, and certainly the things that were not doing as well last year have done much better. Now, however, in the last week, from 2 Fridays ago, the nice bounce higher, last Monday, the follow through, and now into this week, we're starting to see a bit of a resumption of an upswing. These Mag 7 names were beaten down quite a bit and now popping higher. So the question on everyone's mind, including my own, is, is the low in? Was that low that we experienced, about a week ago? Was that it? And now we just need to be back on full offense? Or is this sort of a counter trend rally within a longer term downtrend? One thing I've learned, besides looking at the macro conditions, which I follow and go through in detail every day on my market recap show called Chart This with Dave Keller, which you should check out for sure. Besides looking at conditions of breadth and sentiment, which I think help us understand the price behavior a little better. We can also focus on what I call the line in the sand technique. This is identifying key levels, key signals, key moments that would help you understand that something's different. The way I approach the markets, it's not assuming I'm going to be right. I actually assume I'm usually going to be wrong. And so when I make a trade or when I make a call or when I take a position, I'm always defining my exit strategy, right? So if I'm long a particular stock or a particular chart, I always say, and if this happens, then I know I'm wrong, right? And I always try to define that right up front. So I would argue with all the Magnificent Seven charts right now and the others that we'll include in today's video, I think it's pretty clear to determine the general sense of what the stock is doing. I think it's pretty clear to identify some key levels. And so it's all about picking your trade, right? Selecting your position, but then defining what would tell you you're wrong. So I hope through this exercise in today's show, we'll go through those and help define how we would be wrong on each of these 9 different charts. I didn't even count them before. I just started adding them to a list. All right. So we're going to start by looking at just setting the table for this meal we're going to have together by looking at performance year to date. I love performance charts on StockCharts because they just help you understand the environment, right? I was taught when in doubt, zoom out. So if you're focusing too much on day-to-day movements, on moment-to-moment, what we call flickering ticks of price action, look at some performance charts, look at things like the RRG, the relative rotation graph, to sort of take a step back and just understand how is what we're seeing today, this week, fitting into a larger picture, a larger theme. So here we're looking at the year-to-date performance of a series of ETFs. We're starting with the MAGS, which is the Magnificent Seven ETF, and it's actually the Roundhill Big Tech ETF. There's no index that I know of that really tracks specifically the Magnificent Seven. The QQQ is arguably probably the best index or ETF that I think is close to their performance, although there's obviously a lot of other stocks involved in that particular ETF. So the MAGS is a pretty good proxy for how this group of mega cap growth stocks is actually doing. And the news is not great. Even with the rally that we've experienced in the last week, Magnificent 7 ETF, the MAGS, is down at 10.6%. Now, it was down over 15% about a week ago, so we've had a nice rally and have maybe regained some of that, but still, again, quite a bit down year to date. Let's keep that short-term rally in proper perspective. It's been a bad year so far for for mega cap growth stocks. The QQQ, the NASDAQ 100, which is kind of like this group of stocks, and then about 90 some others, down 4.2% year to date. The S&P 500 down just over 2% year to date. The equal weight S&P 500, with today's rally, I'm recording this kind of midday on Monday, March 24th. The equal weighted S&P 500, ticker RSP, that's an ETF that tracks the equal weighted S&P, actually back up for the year, up 0.4%. TLT is Treasury bonds, and that ETF is up 3.5%. Here's gold, up 14.4% year to date. So the story has been hard assets over bonds, bonds over stocks, regular, average stocks over Magnificent Seven. That's kind of what this order tells you. But if you look at the last week, see how this is looking kind of like the alligator jaws kind of, starting to snap back a little bit. We have gold and bonds, which have been the best performers, rotating lower over the last week. We've seen all the equity ETFs rotating higher. So, still, again, I would say the larger theme is still kind of, rocks over paper, hard assets over soft assets. However, the short-term rotation is having, was really causing me to revisit the charts of the Magnificent Seven stocks and just really think about, why am I, thinking that there's a particular trend in place? What would tell me that I'm wrong? So with that in mind, let's go through that. And I've actually took the liberty of bucketing the Magnificent Seven names into let's see, 1, 2, 3, 4 buckets. The first bucket would be just clear uptrend charts, of which there's only one left. I don't know if you can guess which one, but I'll give you a second to think about which one that might be. Only one of them, I would say, is still in a primary uptrend according to traditional methodology, and in a clear uptrend, no questions asked. Two of them have pulled back to test an ascending 200-day moving average. One of them is a clear outlier downtrend below 2 downward sloping moving averages, and that leaves us 5 more which are currently below their 200-day moving average, testing them from below. And I think that's key. That is probably arguably the most important thing you may take away from this video, is focusing on the 200-day moving average on some of those particular charts. So let's start with the one. If you guessed Netflix, you're absolutely right. This is the only one out of this bucket of 9 names, leading growth names, that is actually above both its 50 and 200-day moving averages as we record this video. Netflix just recently, in the last couple days, regained its 50-day moving average after breaking below it the first week in March. You can see we haven't even gotten close to the 200-day moving average since early August, while most of the other Magnificent Seven names have broken their 50-day, broken their 200-day, and are stuck and maybe testing or sort of around at or below those levels. Netflix is a clear outlier. The other thing that stands out on the chart of Netflix to me is the fact that it's still making a pattern of higher highs and higher lows. Right? If you didn't know that market conditions were super volatile and uncertain here in March of 2025, you probably wouldn't know that by looking at the chart of Netflix, because it's making this kind of clear stepwise motion of higher highs and higher lows. I mentioned, the concept of when in doubt, zoom out. If you just literally take a step back from your monitor and look at the chart of Netflix, it's a pretty good chart, right? Higher highs, higher lows. Now, the momentum isn't perfect, right? I mean, the RSI's gotten pretty low on these recent pullbacks, so we're having kind of an exaggerated swing to the upside and the downside. It makes me feel like swing trading and just looking for overbought and oversold conditions. Turns out that could be a pretty decent way of trading some of these price swings on charts like Netflix. However, I mean, it strikes me that's in a general uptrend. So primary uptrend, I would say thumbs up. What would tell me I'm wrong? What would tell me that a bullish thesis on Netflix is incorrect? Quite simply, we have to stop making higher highs and higher lows, in my assumption, which means 2 things. Number 1, we have to fail to make a new high above 1,050, right? These last couple upswings, we've made a new all-time high. We've made a new all-time high on a gap there in mid-January. That was on January earnings. Next earnings coming up mid-April, so we got a couple more weeks, 3 more weeks or so until that would happen. So for now, it's do we regain and make another new all-time high, Netflix over 1050? If not, you wait to see if that swing low from early March holds. The kicker is every time Netflix has pulled back, we've made a higher low. I would look to see if that changes, right? So the bear case from here would be we could start to stall out maybe around 1,000. The RSI never really gets above 60. For me, that would be a big kind of kind of red flag that things might be changing. So we make a lower high. That would all of a sudden make this look like a big potential head and shoulders topping pattern, which would mean this trend line connecting the lows would become a neckline, and you look to see if we break that as a big sell signal. That's probably what I would look at. And in worst case scenario, we break below 850 and undercut those March lows. So Netflix, I would argue, out of all of these charts I'm about to show you, by far still in the most constructive position. It's the only one above two upward sloping moving averages, the only one still making higher highs and higher lows with no question. And so I would argue still quite a bullish chart. All right, the second bucket, which is Meta and Broadcom, and I added Broadcom as kind of a Magnificent Seven and Friends name. It wasn't part of the original Mag 7 group, but for me, I think it's a leading growth name, similar size to some of these other names, and I think deserves a spot. From a technical perspective, you'll see how Broadcom and Meta are actually very, very similar. I think the thesis here is pretty simple, right? Instead of Netflix, which held its 50-day, or at least has pulled back above its 50-day moving average, Meta has broken below its 50-day moving average. That was a big sort of red flag of sorts for this particular chart. Now we are testing the 200-day moving average, actively testing the 200-day moving average. We sat just above it last week, a couple days. On Friday, we traded off of it. Today, we're gapping up a little bit to trade up to just over 620, but overall kind of stalling out here a little bit. And the question I would say on the chart of Meta, does the 200-day moving average hold? And if it does, I could buy the argument that we're in a recovery phase and that pullback was significant enough. If we fail to hold the 200-day on a chart like this, I think that signals a much broader decline, most likely playing out not just in Meta but in other charts, because it's highly unlikely that the S&P and the NASDAQ 100 would be able to mount a significant advance beyond what we've seen so far without the Magnificent Seven participating in some pretty meaningful way, which means Meta has to hold its 200-day moving average. So for me, breaking below 570, which would take us below the 200-day moving average, that would be the big alarm bell for me, telling me get out of the way of Meta and probably other risk assets as well. Broadcom, kind of a similar take. It's a little different in that I can't draw a horizontal line right at the moment. Well, I can. I'm in charge. It's my screen. All right. Let's draw a horizontal line, and I'll show you why this level is important for a couple reasons for the chart of Broadcom. Now, I'm making this kind of thick line just to highlight that the June 2024 high was right around 182. That's pretty much where we topped out in October and November, and then December of last year before the gap higher. And that was not an earning. It was earnings, I think. It was mid-December earnings, I want to say, was that gap higher. Now, we gapped higher, finally getting above 182, which is a very bullish development going into year-end. From there, though, we never really made it above 250, which was the high a couple days after that gap. Then we had a gap lower in late January. We made a lower high. We're below the 50-day moving average finally. Now we're testing the 200-day in early March, also testing that 182 level. This is a technical analysis concept called polarity, where resistance becomes support. It is well documented in the technical analysis literature, that idea that levels have meaning, right? It's related, I would argue, to the behavioral finance sort of topic of anchoring, right? We anchor to a particular level, and as a result, the market has memory. It tends to gravitate around that level. Pivot points are another way that people describe that sort of a thing on a shorter term basis. So I would say 182 is kind of that key pivot point. So now where are we at? Well, we bounced off of what's called a confluence of support, the 200-day moving average and that 182 level, which had served as resistance in the latter half of 2024. Now that level becomes support. It held in early March. Does it continue to hold? And I would say for now, Broadcom, you could label it as a strong pullback within a primary uptrend because we're holding the 200-day moving average. However, if the 200-day does not hold, if we break below 182, that would get below the 200-day moving average for the first time in over a year. That would get below that pivot point or that anchor around 182 and finally fail to hold that early March low. I mean, it's not good because we are making lower lows and appear to be making a lower high just below $200 a share. But I would say breaking 182 would be the trigger for me, suggesting a new, probably significant leg lower for charts like Broadcom. So there we go. Let me save that chart. All right. So there you go. You've got Meta and Broadcom, the two stocks that are sort of waiting to see if they can hold the 200-day. And I think with those, clear objectives. They pulled back quite a bit. They could recover from here, but a break below the 200-day would be it. That would be the nail in the coffin for the bull case, I would argue. All right, the third bucket only has one name, and it's Microsoft. Microsoft, out of all these stocks, is the only one that is currently below 2 downward sloping moving averages. It's the only one where the price is at the bottom, then a declining 50-day, and the 50-day is below a declining 200-day. Kind of checks all the boxes of bad right now in a primary downtrend. Paul Tudor Jones famously said nothing good happens below the 200-day moving average. I feel like the chart of Microsoft with that gap lower in early January, then continued distribution really tells you the story here. If you're buying Microsoft on it, like a week, like in the last week, you're buying it because it's been down so much, right? You're buying it because it's gone down a ton. It's way below recent levels. You have to be thinking more of a valuation approach, thinking that the valuations have come down relative to where they were when the stock's at like 450. Now we're down around 380, which means it's a much lower valuation just based on the same fundamental structure. But the question is, from a technical perspective, what's the trend? And I would say the trend is absolutely down here, right? Until proven otherwise, I think of this chart as guilty until proven innocent. We're making lower highs and lower lows. We're below 2 downward sloping moving averages, which means all of that needs to change. We need to stop making lower lows. We need to make a higher low. We need to break back above the 50-day moving average. At the very least, to signal some sort of improvement to the degree that we're actually regaining a short-term moving average. I think that's pretty important. Also look at the RSI, which has been below 50 for most of 2025. It briefly broke above there in late January, but didn't get much above 60. So that really is confirming more of a bearish range. So you want the RSI to push above 50 and ideally push above 60 on a rally, suggesting that there's an influx of buying power with the potential to push the price higher. Until we would see that, I would argue that the chart of Microsoft is in a clear downtrend. So for me, looking for a break above the 50-day moving average around 408, looking for an improvement in momentum with an RSI pushing above 50, ideally over 60. Until I see those, I would say Microsoft still in a fairly clear downtrend. All right, now we get to the the fourth bucket, which are the other 5 names in this group, and these are all 5 that are testing their 200-day moving average from below. Now let's start with the good news. Amazon actually looks like it might be regaining its 200-day moving average today on Monday, March 24th. And actually this breakout in Amazon above its 200-day was one of the reasons that sort of inspired me to make this video today for you, was seeing that it had broken back above its 200-day moving average and starting to think, all right, what else could we think about in terms of key levels for all of those leading growth names and just reflect on what we would need to see. The chart of Amazon, obviously in deterioration mode, and I would say with all 5 of these charts I'm about to show you, I would argue the trend has been down because all 5 of them broke below their 200-day moving average, most in February, March, and are really signaling a period of distribution. So what you look for with charts that are below their 200 is quite simply breaking above the 200-day and popping above it. Trading slightly above it for one tick is not enough. For me, to digress for a moment, what would tell me that a chart of Amazon is actually getting better? Number 1, we need a valid close above the 200-day moving average. Number 2, you need what's called a follow-through day. And most of my mentors, like Ralph Acampora, John Murphy, Larry Williams, Tom DeMark, all included some concept of follow-through in their work. So, whether it's at least one day of trading higher with Tom DeMark, it was like the next bar you need to trade 1 or 2 ticks above that first day to validate it. John Murphy, just another day of strength, if I remember right. As I was learning the technical analysis toolkit, that concept of follow through became very important to me because to my mentors, that was a key way of minimizing whipsaws, right? What could happen on a day like today is we open and trade above the 200-day by the close. Let's say we sell off in the next couple hours. All of a sudden we finish today below the 200-day. So that's actually not a valid breakout if we trade above it but don't close above it. So for me, we need to close through the level and then have another day that sort of continues in that primary upwards direction. If that would happen, I would say the chart of Amazon all of a sudden starting to look a little more encouraging. We are showing a bit of a bullish momentum divergence here in the month of March with lower lows in price, slightly lower, and slightly higher RSI. That's encouraging, but getting above the 200-day is key. So I would say out of all these charts, the one that's actually showing some encouragement, besides Meta and Broadcom maybe holding their 200-day, I would say Amazon breaking back above its 200-day today, pretty important. My question would be through the course of this week, do we close above it and then follow through? And if so, that could mean at the very least much further of an upside recovery until something else happens. Tesla, still below its 200-day moving average. We can see a nice bounce today. It's up about 10% today after a nice rally on Friday, still below the 200-day moving average. The RSI still below 50. Here is Apple, still below its 200-day moving average, actually testing that support level from January around 220. That was the January low. Remember that concept of polarity. So there's the November low around 220. Here's the January low around 220. We broke below 220 after failing to hold the 200 down. Now we're testing 220 from below, which means that's a short-term level of resistance. If we would break that, 228 would get us above the 200-day moving average. I think that would be what you would need to see on the chart of Apple. On the chart of Alphabet, again, making a clear pattern of lower lows and lower highs. That needs to change. We need to see Alphabet get above 175, and if so, that would actually take us to a new swing high because it would get over the early March swing high. RSI needs to improve. It's been below 50 since early February. So again, you need to see improving momentum and breaking above a key level of resistance. NVIDIA is the last one, so I won't rapid fire through a couple of those just for the sake of time, but I think those are pretty straightforward. You need to get above the 200-day moving average. Now with NVIDIA, I mean, it's maybe the most interesting chart for a couple reasons. Number one, I think a clear downtrend channel of lower lows and lower highs, which means following that kind of channel approach, you got upside to like 130 or so and still be within a clear downtrend channel of lower lows and lower highs. I think that's one thing to note. Another thing is, over the last week, NVIDIA appears to have made a higher low, which is what many of these stocks have not done yet, right? They're still kind of in a primary downtrend, like Alphabet. NVIDIA is actually arguably making a higher low around 115 last week, which means today's bounce could be validating that higher low and signaling a move to further upside. The RSI is just slightly above 50, which is better than those last four names that I just showed you. So what would we need to see on the chart of NVIDIA? For me, again, breaking above 120, 123 would basically clear that. 122.50. We'll call it 123 to get above that swing high. That would mean a higher low and a higher high on the tactical time frame. For me, getting back above the 200-day moving average, not to be a broken record, but with these charts that are below it, I just feel like I'd much rather own a Netflix than an NVIDIA until something like this is back above its 200-day. That's why running a scan on the StockCharts platform, by the way, for stocks that have been below their 200-day moving average and just breaking above it, easy scan to make in StockCharts. I would encourage you to check out that type of scan because I think it could be a really easy way of identifying stocks maybe that are starting to rotate higher after being in a period of distribution. So 128, that would be the level I would be looking for on the chart of NVIDIA. Now, I have gotten some questions recently about the death cross, where you can see the 50-day crossing down through the 200-day moving average. The short answer, I would say, is not the most important thing on this chart. The 50 and 200-day and what's called the golden cross when it crosses higher, the death cross when it crosses lower, often comes up, and certainly in the major media, I'll often get asked about death crosses or golden cross. They have great names that make for great headlines. But if you actually backtest the 50 and 200-day moving averages and those death crosses and golden crosses, it's not the best trading system you're ever going to come up with, to be honest with you. It's more visually it stands out, but if you think about it, what happens is often, particularly something that's more volatile, it will often give you signals way late and will often give you buy signals way after the bottoms actually occurred. So I've learned to not put too much weight in things like a death cross. I'm much more focused on the pattern of the prices, the price relative to the 200-day moving average, and the momentum characteristics to see if they can prove enough to tell me that the price is actually going. Something like a moving average crossover is going to come way later as a confirmational tool, but for me, some of those other actionable signals that we talked about, particularly NVIDIA getting above 128, I think that would be the sign that we're in a bit more of a recovery than some bearish investors, including myself, would probably expect as a likely scenario. So there you go. That's a rundown of those leading growth names, what key levels I'm looking for, how to think about those charts, and honestly, why looking at those charts can be so valuable. I'm going to be using the scanning tool on StockCharts.com. I'm obviously using the chart list tool, which is the set of charts that I just showed you. Can't stress enough. I think a platform like StockCharts really is worth your time and investment, and pays for itself many times over if you use some of those tools like the scans, like the alerts. So any of those levels we talked about, set an alert today to have the platform tell you when those levels are actually broken. That's how you really become a power user of a powerful platform like StockCharts. By the way, if you want to follow some of these patterns day in, day out, if you want to see how these things play out every trading day as we follow the Magnificent Seven, the S&P, the NASDAQ, and many other charts, you're probably looking for my market recap show, which is called Chart This with Dave Keller. It's every weekday after the close at 5 p.m. Eastern, and I live stream on my YouTube channel, which is called Market Misbehavior, also on Facebook, on X, and on LinkedIn. So make sure you follow me on all the socials. Definitely subscribe to my YouTube channel, and you can check out that daily market recap show. Also want to let you know, by the way, we've had some really cool interviews in my Market Misbehavior podcast. We had 2 interviews that we posted last week. Actually, just over the weekend, we posted an interview with Jay Soloff. Jay's at a firm called Investors Alley. He's an options strategist, former market maker on the floor of the CBOE in Chicago. And we talked all about volatility. We talked about the VIX futures and the term structure, key levels in the VIX and why they're important. If you've looked at the VIX and have been ever slightly confused about what the levels actually mean, how to think about the VIX and VIX futures, make sure you check out that interview with Jay Soloff. Also, Jim Puplava is a longtime money manager and media host. Jim is at a firm called Financial Sense Wealth Management based out of San Diego. I've been on Jim's podcast a number of times. He always asks such thoughtful questions. So I had a really good time talking to him about comparing the short-term noise that we're all experiencing with the long-term perspective. So make sure you check out the interview with Jim Puplava, and also Jay Soloff was the other one, both on my YouTube channel, the Market Misbehavior podcast. That's it for today. Have a great week. Hang in there with all of the news flow, all the events, and make sure you use the StockCharts platform to navigate things along the way. But in the meantime, have a great week. And remember, it's always a good time to own good charts. Take care, everybody.